Historically, one of the best performing periods for precious metals has been when the Federal Reserve begins to raise artificially low interest rates. While investors initially expect rising interest rates to be bad for precious metals, they forget that even as the Fed begins to raise artificially low rates, interest rates will remain very inflationary until they reach a level that is higher than the real rate of inflation. During the 1970s, gold's bull run from $35 per ounce to a high of $850 per ounce for a gain of 2,329% came during a time of rising interest rates. If we go by gold's low of $250.95 per ounce in 2001, if gold makes the same percentage gain during its current secular bull market, gold could easily reach $6,200 per ounce before its bull run is over. The best way to gauge inflation is to simply look at the price of gold. Gold is the most stable asset the world has ever seen. In 1970, you could have bought a nice men's suit for 1 ounce of gold or $35. Today, you can still buy a nice men's suit for 1 ounce of gold, but $35 won't even buy you a nice t-shirt. Although the Federal Reserve doesn't admit it, they secretly watch the price of gold like a hawk. If the price of gold melts up too quickly, it's a sign that the dollar bubble is coming to an end. The silver market provides a window into what is happening in the gold market. Because the silver market is minuscule compared to gold, silver prices are usually very volatile and swing both to the upside and downside by much larger percentages than gold. Based on recent events in the silver market, it appears as though the Federal Reserve bailouts of Wall Street may have been in part to artificially suppress precious metal prices.
On March 14, 2008, the very day Bear Stearns failed, we saw silver hit a multi-decade high of nearly $21 per ounce. Bear Stearns was on the verge of having to cover their short position, which could have easily sent it to $30, $40, even $50 per ounce. Instead, we see the Federal Reserve orchestrate a bailout where JP Morgan acquires all of Bear Stearns' assets with the backing of the Fed. Next thing we know, JP Morgan, they acquire the silver short position of Bear Stearns, manipulate the price to below $9 per ounce.
The CFTC's own reports of November 2009 show that just 2 banks held 43% of the commercial net short position in gold and 68% of the commercial net short position in silver. In gold, these 2 banks were short 123,000 contracts, but long only 523 contracts. And in silver, they were short 41,000 contracts and long only 1,400 contracts. How improbable is that these 2 banks attract most of the investors who want to sell short?
JP Morgan is now short approximately 30,000 silver contracts, representing 150 million ounces of silver. This is one of the largest concentrated short positions in the history of all commodities, representing 31% of all open COMEX silver contracts. Another 7 commercial banks are short a total of 35,000 silver contracts, combining for a total commercial net short position in silver of 65,000 contracts. This means commercial banks are now short 325 million ounces of silver that they will eventually have to cover by purchasing these 325 million ounces of silver back in the open market. This could create the largest short squeeze in the history of all commodities. Since the beginning of World War II, the world has consumed more silver for industrial uses than it has produced from silver mining and recycling. 70 years ago, the world had 10 billion ounces of above-ground silver inventories. Today, it is estimated that there are only 1 billion ounces of silver inventories left. Silver is currently only 1.5% the price of gold, despite the fact that above-ground inventories of gold have become much more plentiful than silver. In the first quarter of 2010, the U.S. Mint sold 9,023,500 American Silver Eagles, the most since the coin debuted in 1986, and up from 8,299,000 sold in the fourth quarter of 2009. All U.S. silver mines combined are currently producing only 40 million ounces of silver annually. This means that the U.S. needs to use almost all of its silver production just to keep up with the demand for American Silver Eagle coins.